Has inflation actually peaked following the latest CPI report? Well, that is a critical question that is on pretty much everyone's minds right now. And we'll be discussing this issue with our next guest, Nathan Lewis, who is the author and editor of the Polaris Letter. Nathan is also the author of several books, including the latest one, which he co-authored with Steve Forbes, entitled Inflation, What It Is, Why It's Bad, and How to Fix It. We'll be discussing with Nathan some practical and theoretical solutions to fix inflation in the short and long term. Welcome to the show, Nathan. Welcome to Kitco.
Hello, David. It's good to be here.
Nathan, let's start by talking about your definition of inflation. Before we even get into the numbers, the headline and the core and your projections, what is inflation? Now, you've defined inflation as something a little bit different than what most people might. You've said in your book that inflation is the distortion in prices that occurs when money loses its value. Well, isn't that just the same thing as prices going up?
Well, it's a little different. Unfortunately, we've tended to connect the term inflation simply to the CPI. The CPI didn't even really exist before 1940. And inflation's been around a lot longer than that, including the word. So we want to get an idea of what the heck we're talking about. Where does it come from? What process is involved? And in the book, we separate this into two basic categories. Many things can influence prices. Many things. That's why in the headlines we're talking about 100 different things, right? But we separate in two basic categories. One is various supply-demand issues in individual goods and services, whether it be a tight labor market, housing shortage in certain locales, all the supply chain stuff that's still going on, still no cars in dealers' lots, and all the things we talked about, consequences of the military activity in Ukraine and so forth. And then there's a whole separate category of influences, which is basically monetary. It doesn't really have anything to do with supply and demand of individual goods and services. It's really just central bank mismanagement of the currency. It's really just the consequences of changes in the currency value. We have floating fiat currencies, they change in value, and there are consequences of that. And now we're having, at this time, really both of those things come together. And that's pretty unusual in economic history of the US and around the world. And unfortunately, experts tend to specialize in one or the other. They're either type 1 supply and demand specialists. This is the Keynesian aggregate supply, aggregate demand format. Or they're kind of monetary specialists in the, everything's monetary for them. And what tends to happen, basically what we have is a situation where everybody is half wrong. So that's one of the reasons why we're so confused today.
What are we confused about exactly? The definition, the measurement tools, how to fix inflation? Where's the confusion coming from, Nathan?
Yes, exactly. All those things. So in terms of how to fix it, we have real supply demand issues in individual goods and services these days. And the way to fix those is just to go into those individual sectors and fix the problem. If there's not enough houses, build more houses, right? If there's a issue with chip supply from Taiwan, well, make more chips. Nothing the Federal Reserve can do is going to fix that. Then there's the monetary stuff. And it's really easy to understand. We've been playing this game for thousands of years. Governments have reduced the value of their currencies. In the old days, they used to reduce the amount of silver in the coins. Now we have floating fiat currencies. It's all kind of virtual. Well, guess what? Central banks around the world were extremely aggressive in response to COVID in 2020. They created a lot of money. And not very surprisingly, the consequence of this is with more supply of money, the values of the money essentially fell. Gold investors noted the change in the number of dollars it took to buy an ounce of gold from about 1,200 to about 1,800 today. And that eventually all prices will adjust to that new reality. When the currency goes down in value, prices eventually adjust higher over a period of years to compensate. And we've been playing this game a long time. And it's pretty easy to understand, but you never hear about that. When's the last time you heard about changes in currency value? You always hear about interest rates and so forth. So we're trying to untangle some of this stuff so we can come up with rational, effective solutions.
Okay. Some of these bigger ideas and bigger solutions we'll discuss later in this interview, but I want to talk about practical solutions that the government is trying to employ right now. First of all, let's go back to the CPI numbers. Now, 8.5% is headline CPI year over year. Month over month, it's unchanged. Core CPI, which excludes food and energy, actually went up 0.3% month over month and 5.9% year over year. So most of the decreases in the price, if you want to call it that, or the slowdown in the increase at least, is from energy. Because if you strip away energy and food, the CPI, the core CPI, is still up slightly month over month. The question is, Nathan, is this actually the peak? If you consider that this trend is to stay, if you consider that headline CPI doesn't actually increase on a month-to-month level, then on a year-to-year level, it has to start decreasing because the CPI index rebased to the previous year is going to start catching up.
And normally this is kind of what you see. And I think actually the administration's arguments are fairly valid. Usually these kind of supply demand issues resolve themselves pretty quickly. In history they have. But this time they're pretty persistent. When's the last time car dealer lots have been empty for what's it been, 2 years now? And part of that is government regulation, part, interference in the economy and so forth, whether it be, COVID restrictions applied to trucking industry and all these things. We've talked about them. To the extent that the government relieves those roadblocks, some of those prices should be coming down. And we still have had this substantial decline in currency value on the monetary side, on the Federal Reserve side. The value of the dollar and the value of currencies worldwide roughly went from, let's say, $1,200 per ounce to about $1,800. Well, that's a 50% increase in the amount of dollars it takes to buy an ounce of gold. Well, all things being equal, although they're not quite, but we can think that way. That means that the amount of dollars it's going to take to buy everything else will probably go up about 50% over the next several years. Well, that's a lot, right? We've moved about 10%. It's not that pleasant. So there might be some more of that filtering through. And however, I think the Federal Reserve has apparently, they realized they went overboard in 2020. They've done a lot to walk back a lot of their money creation. Actually, the base money supply, monetary base, is contracted by about $1 trillion. It took about $1 trillion out of the economy after putting about $3 trillion in. And that's one reason why we haven't seen the dollar decline further in value from this roughly 1800 level. Dollar's very strong on forex markets. And so as long as they're able to keep the dollar from falling further, then we should not have a new, impulse of monetary inflation that will cause prices to rise further still.
Okay.
The question is, of course, how long will they maintain this? If we get into a situation where there's a recession and, Congress wants to spend a lot of money and they want the Fed to pay for it again, as they have in the last 15 years or so, we might get another cycle of currency debasement, currency debauchery, which has been going on kind of intermittently since 1971, since we left the gold standard. The value of the dollar today is about 1/50th compared to gold to what it was in those days. So we've been playing this game a long time, and we might get another act in the play coming up soon. I think we should probably expect that, which would mean more inflation.
More inflation. So before we move on, what is your projection for the numbers for the following year then? You don't have to give an exact number, but basically up or down from 9.1?
I think we'll probably see a decline in the CPI number. Just as you say, they have to keep on going up to get a higher CPI number. If they just kind of stay flat at a higher level, then they should come down. I think we might see substantially higher energy and food prices simply because of supply demand issues in energy and food. We know that there's been all kinds of restrictions on drilling, some voluntary restrictions, oil companies returning cash to shareholders rather than investing. Just across the board, commodity prices reached very low levels in 2019 and 2020. In 2019, U.S. farmers hadn't made profits in 2013. And if you want to eat, those guys got to make some money, and that means higher prices. So there's issues of that sort too. Commodity prices just have to go higher for these guys to make a living, and they have. So I think that we might see somewhat elevated prices for a while, but the real question I see going forward is, are we going to have, let's say in the 5 to 10 year time frame, another inflationary impulse, another round of easy central bank money creation, or many forms it might take. Even we had sort of effective MMT, central bank financing of government spending in 2020. It wasn't official, but that's kind of more or less what happened. And if we do that, we get into that habit, we could have a lot of inflation. And
Okay.
in addition, we're now getting into a sovereign debt issues around the world. Japan, definitely. Europe, especially with Italy. US is relatively better, but only relatively.
Right.
We have uh, pretty high debt to GDP ratios, plus pretty high kind of structural deficits. And these are all political influences that have dragged many governments down the path of money printing in the past. And even if we try to resist it, we are going to experience those pressures going forward, I think. And that
Okay.
means potentially a lot more inflation.
Potentially a lot more inflation. Okay, so 2 points on that. The first, I've addressed this to a number of guests who also share your viewpoint, Nathan. But the fact remains that if you look back in history, over the past 70 years, we've had a number of recessions. In none of those recessions have you seen the CPI actually tick up or inflation tick up during the recession. Maybe right before, maybe right after, but during the shaded periods that the NBER designated recessions, inflation actually has always come down. Even in the late 70s, when you remember we had really high inflation due to OPEC, that technically wasn't a recession yet. A recession was 80 and then 81. So how would you respond to the argument that during a recession, inflation typically goes down? We are technically in a recession now.
I think that's actually a pretty good argument. I'm not seeing a lot of obvious, reasons for prices to go dramatically higher here. I'm seeing a number of reasons for them to moderate. Housing market's clearly coming down pretty substantially. Yes. The jobs market looks pretty tight for now, but recessions, it means more unemployment. And in fact, that's the Fed's big plan, isn't it? To create enough unemployment to bring prices down. They keep talking about that. They'll probably get what they want. So yes, I agree. For the shorter time period, you're probably going to see that. But that's exactly the framework that we've always seen in a recession, which then gives a green light to the central bank to say, okay, it's easy money time again.
Yes. Okay. So maybe later on we'll get a revisit. We will revisit inflation, but for now things might cool off. Well, what about deflation? You've talked about asset prices cooling off, like housing, for example. What about consumer prices deflate? You know that old adage, the trading adage, what goes up must come down. Does that apply to consumer goods as well, Nathan?
Well, I'm not sure that Walmart's prices are going to come down dramatically. um, things certainly some things, used car prices, they're going to crash. Okay. I mean, I would expect,
Okay.
They went $10,000 too high, and they could come down $10,000 down, which would, and that was a big part of the CPI burst. It was about a quarter of the entire move. So that's important. Housing prices, I think, will come down. Maybe rents as well. So yes, you're going to see that type of thing. I expect if we have a recession, I think we're going to have a fairly substantial recession, I would guess. Basically bigger than 2002, which was the last Nasdaq bust, if you recall. So yes, I agree with that. But that's what gives the green light for the central banks to get busy on the money creation side again.
I want to cite one of your passages from your book. You wrote that if you want to know what's happening to the dollar or to the value of the dollar, gold is where you should look first. When the price of gold rises, in other words, when more money is needed to buy an ounce of gold, that usually means that the dollar's value has decreased. Well, why the dollar in particular? I mean, you could apply that argument to any currency, right? Any fiat currency.
Yes, exactly. You could. Well, we have an American audience. That's the only reason. Yes, you could say the same thing of the euro. You could say the same thing of the yen. You could say the same thing of the Mexican peso.
But Nathan, why peg the value of a fiat currency to the value of gold? I mean, this is probably a rudimentary question, but I think it's probably best to explain to the audience. Why not peg it to silver or diamonds or lumber or any hard asset for that matter? Why gold in particular?
That's a very good question. And it's oddly that there's kind of confusion about this. People in the past were very clear. It was not just superstition, right? Just a custom they don't understand. They were very clear. Well, what we want is a stable currency. We don't want a currency that goes down in value because that causes inflation. We don't want a currency that goes up in value because that causes deflation. We want a stable currency. And the way that this has been traditionally achieved was with gold. It's the most stable thing around. And it's also unpolitical, right? It's not a bunch of PhDs arguing in a room. It's the most stable thing around. And not only is it theoretically a good idea, but in practice it's a good idea.
PhDs, just to clarify for the PhDs watching this right now.
Well, as long as they're not involved in your money.
All right, fair enough. Okay,
yeah.
please continue.
And so it's an idea. It's an idea that not only has a theoretical basis, but has in practice worked very well for centuries. So it's very hard to think of a better solution.
Okay, fair enough. One way that you've suggested that the governments could use to combat inflation is with austerity. I'm going to quote another passage from your book here. You said one inflation fighting strategy is austerity, a combination of harsh tax increases, super high interest rates, government spending cuts, and yes, more currency devaluation. The objective of austerity measures is to tamp down inflationary price increases by creating a recession to break the back of inflation. Okay, so I'll let you explain exactly what you mean by that. It sounds to me like you're advocating for the governments to create a recession, or some might argue, the greater of two evils.
Well, I don't make that argument. But I said we're arguing this is a very common argument that you hear, and we disagree with it. Now, if you just think about it, if the monetary type of inflation is caused by declining currency value, then just don't do that, right? Keep the value of the currency from declining further, and you're done. You don't need a recession. and not only that, the recommendation we say in the book is that in addition, what you can do is often lower taxes result in a stronger economy. So combine this monetary reliability, stability with lower taxes, and that two good things tends to produce a good result. And that's exactly what Ronald Reagan did in the 1980s. Ronald Reagan and Paul Volcker. Volcker stopped the dollar from declining in value, rather messily, rather clumsily, but he did it. Reagan cut taxes, inflation went away. And it seems obvious today, but a lot of people at the time argued the opposite thing. Yeah, I said, well, we need much higher taxes to stop inflation because if we take people's money out of their pockets, they can't spend it. And then to deal with all the employment, we need an easy monetary policy. And that's what, stupid stuff like that is why the 70s went on for a whole decade. So this whole idea of, you need a recession to break the back of inflation, we disagree with. If stopping inflation is a good thing, then you should have a good economy that results.
Okay. All right. Well, what about the notion of spending more money in certain areas to fight inflation long term, which is essentially, if I understand correctly, the notion behind the Inflation Reduction Act? $400 billion, but proposed spending hasn't been passed yet. But proposed spending, $300 billion of that is earmarked to fight climate change, 15% minimum corporate tax. Is that a feasible solution?
Well, no, basically. The government can influence these things mostly through kind of regulatory things which don't cost any money. For example, there are a lot of issues with house prices these days in certain locales. All the municipal governments have to do is say, yeah, go build some houses, try to get the permitting process, shrink it down from 5 years to 6 weeks or something. And it'll be fine. You don't have to spend any money. I can hardly think of anything the government can do that involves spending large, $100 billion sums that actually will help fix the problem. On the monetary side, just keep the currency from falling any further, and you're good. Mm-hmm. So I disagree with this. It just sounds like some excuse making to buy election votes.
Fair enough. All right. So looking long term then, because we did talk about short term inflation. Long term, I think this is one of your quotes. You wrote that I personally think that we will eventually end up in moderate hyperinflation of the sort common in Latin America during the 1980s. Actually, some Latin American countries still have hyperinflation today, Venezuela being one of them. First of all, do do you agree with the definition of hyperinflation that 50% month-over-month inflation is necessary for it to become hyperinflation? And second, if we were to get there, how?
That's a good question. There's sort of definitions of hyperinflation, and there's actually a accounting standards board, International Accounting Standards Board, also adopted by the U.S. Federal Accounting Standards Board, definition of hyperinflation, and it is basically a 100% increase in the CPI over the course of 3 years. That's actually about 28% a year compounded. And it's like, 28% a year. Okay, that's like 2% a month. It doesn't sound very hyper to me, but this has arisen from the experience of real companies in real hyperinflationary environments, and that was the word used. They used the word hyperinflation. When Coca-Cola was in Mexico in the 80s, when Pfizer was selling drugs in Chile in the 70s, whatever, they had to do accounting, and they said, "What the heck are we going to do? Everything's are going up. We don't know what's what." And so this comes to a real world experience, and I would suggest that right around that point, right around that 20 plus, CPI kind of reading, that's when things just fall apart. You can no longer make loans with any kind of maturity. You can no longer set contracts with any kind of longevity. Everything has to be renegotiated day to day because you don't know what the value of the currency is. And this arises, but I think a more important, not necessarily definition, but understanding of hyperinflation is it's kind of happens when there's a switch in the political process. We've had inflation over the years in the United States, more or less as an effort of macroeconomic management. We want to reduce unemployment. We want to get ourselves out of the 2008 financial brouhaha. We want to do this, that, the other to the macro economy, not necessarily directly funding the government. But hyperinflation tends to take place when they got to make the payroll for the military. There's no money in the checking account, so they just make the money out of nothing. And that is how you get, these 50%, 100% per year kind of rates of CPI inflation. And we're getting close to that, I think. That's what I mean when we're getting into this sort of sovereign debt, deficit crisis, which may play out over the next 5 or 10 years.
5 to 10 years, sovereign debt crisis would lead to hyperinflation in the likes of Latin American countries. This is a very, I wonder in this scenario that you're describing, I wonder what's going to happen to the everyday people. Let's just take Venezuela, for example. They have hyperinflation. They also have very dramatic shortages of basic supplies like food. One of the issues is because the government has instituted supply caps to help fight this hyperinflation, but little do they know this had the counterproductive effect of just limiting everything, and no one now has any food to buy because they also can't import food because their currency has basically deflated to zero. They can't afford to buy stuff from other countries. Ooh, that's a scary situation for any country. Could that happen here in the U.S.?
Yes, price controls are one of the worst things that you can do in a severely inflationary environment. And we make fun of Venezuelans because, how could they be so stupid? But we did the same thing here. We had price controls. Richard Nixon imposed price controls. Some Democrats are already talking about that. It's bad enough when shopkeepers and wage laborers have to renegotiate all the prices every month or so. I need a raise this month because everything's gone up. But then you say, we can't do that. We can't adjust the prices. Then people stop selling things, and the economy just grinds to a halt. This is another, again, very common political outcome. I don't like to use Venezuela as an example because it seems they're so far down the rabbit hole that it's hard to relate with.
Sure.
That's one of the reasons I choose Mexico. They had a hyperinflation, which took the value of the Mexican peso from about 27 pesos to the dollar in 1980 to about 2,700, or I think a little more of that, 3,500, 3,200 in 1990. So that's about 100-to-1 decline. Their dollars became pennies. Prices rose 100%, 100 times higher, which pretty much is scorched earth. But actually, it only translates into about I think 40-50% a year
Right.
inflation rate.
Okay. I just want to ask you one more question about the gold standard. You've proposed a return to the gold standard. In our modern day monetary system, Nathan, how would this transition take place? And what would the final result look like? In other words, could I just go to the bank and withdraw some gold, basically? Can I exchange my fiat for gold? Is that how it will work?
Possibly.
Well,
you can exchange your fiat
versa
for gold today at Kitco. And so, in a sense, that wouldn't change, except the price would be extremely stable. We actually, in the last 200 years, there's really only been two monetary systems in use around the world. One is fixing your currency to some external standard of value. In the past, gold, very popular, although not everybody did it. United States did this for almost 2 centuries, up until 1971. We became extremely wealthy. This is actually a very common system today. The IMF actually banned countries from using gold standard, from linking their currencies to gold in the late 70s. But over half of all the countries today do not have floating fiat currencies. They actually link their currencies to either the dollar or the euro or currency baskets. Some of them do. Some external standard. They have a fixed value system. The currency is worth X, and we know exactly what X is, whether it's gold, euro, whatever. The other option is some form of floating fiat currency with a bunch of PhDs arguing about what they should do next. And that's really the only choices we're ever going to have. So dozens of countries around the world fix this problem, fix their floating fiat currency problem by linking their currency to the dollar. And we say, makes sense. We can't do that because we can't link the dollar to the dollar, and we don't want to link it to the euro. So what options do we have, in the United States? And gold is really the only practical one. So countries get into these problems over and over again. What did Mexico do when they ended the hyperinflation? Well, they stabilized the peso against the dollar. And, what would happen when we if we imitate Mexico over the next decade and have Mexican style hyperinflation? Well, we can't link to the peso. So gold's pretty much the only option, honestly.
Or Bitcoin standard. How do you feel about that?
Well, I think it's completely silly. Now, you've got to remember that people have said the whole purpose of linking your currency to anything else is to achieve as much as you can stability of value. U.S. dollar is not that stable in value, but it sure beats the floating fiat peso of the 80s. Gold is not perfectly stable in value. No one has ever said it was, but we've tried it over 100 years and it's pretty good. Bitcoin is obviously not stable in value. Some people think it will be in the future, but okay, wake me up when that happens. Then we'll talk about it. Okay. Bitcoin completely violates the necessity of having a stable standard of value.
I'm just going to throw this out there because we're nearing the end of our conversation. This has been a very enlightening talk, by the way. This is a silly concept, but I'd like to address it. I'm a fan of Star Trek. In Star Trek, the Federation has no currency. Everyone's basic needs are met. Everyone has housing and food provided to you. In fact, they have these devices. I can't remember what it's called, but you press a button and then it makes food for you. What is it called? Replicators. Yeah. We don't have that today. That's sci-fi. But the notion that we don't need a currency, some sort of payment, some sort of medium of exchange, some sort of store of value, which is what money is defined as, is that a plausible concept that humans could one day achieve? Should we pursue that? Should we pursue that is my basic question.
Well, I take that back. It has been done in very simple societies. Okay. And if you think about Star Trek, you're looking at the Star Trek Enterprise. What's the Star Trek Enterprise? Well, it's a military situation. It's a Navy, military ship. Well, if you're in the Army, you don't have to spend money. You just show up at the mess hall, right? You don't have to buy clothes. They just issue it to you. So yes, in a sense, the military is that sort of communistic society where you don't need cash. But it's we don't see the rest of the Federation that somehow supports the U.S. enterprise.
Exactly, that's my question. How do they? Maybe my Star Trek lore isn't very deep, but how do they, finance the building of the ships? Where does the food from the mess hall come from? Where do the weapons? Like someone's paying for it. in some way.
Yes.
You know,
in the past, there have been sort of command economies, but they're usually extremely simple economies. Now, there's two examples are the medieval manor, which is basically like a little closed economy. The ancient Egyptians sometimes had this. But in today's extremely complex industrial society, you need coordination of literally thousands of people to do anything.
Right.
Just the simplest, people had the example of a pencil, just go try to make a pencil in your backyard. You can't do it. You need thousands of people. You need a paint manufacturer. You need a lumber manufacturer. You need a graphite manufacturer. You need a rubber manufacturer. You need someone to make the metal that make the little band at the end. And how do you do that? You got to get aluminum out of the ground. You got to need heavy equipment. You got to need refineries. All these people's activities have to be coordinated somehow. And the only way which we have ever found to be able to coordinate all those people's activities in an extremely efficient way, with very little, they don't have to have Zoom meetings, with 10,000 people saying, all right, this is what we're going to do to make the pencil. The market does it. And it's kind of a miracle. But if you don't have a market, or the market's messed up because the money's not reliable, it becomes very difficult to make even something so simple as a pencil. Certainly not Starship Enterprise.
Yeah, I think we've advanced to our current monetary system, however flawed it may be, for a reason, Nathan, for a reason. I'd like to end this conversation on this thought, one of your tweets actually. You've tweeted that Bitcoin looks like an NSA project to soften you up for CBDCs, central bank digital currencies. Look up controlled opposition, fake alternatives. I'll just let you describe what that meant. Oh
yeah, well there's a lot of interesting discussion about the origins of Bitcoin. It's somewhat secretive. The actual NSA, the National Security Administration, issued a paper in the mid-90s about basically how to do Bitcoin. So, go if you haven't read that yet, you should definitely go read it because it's very interesting. Okay. And controlled opposition. Why is there so much crazy promotion of Bitcoin as the basis of a new monetary system? It distracts people from the real solution, which is gold, and which has always been gold. And when I say that, don't we already know this? Haven't we been through this over and over again over the last 300, 400, 500 years? It's not going to be Bitcoin. It's not going to be nominal GDP targeting. It's not going to be some stupid thing that didn't exist 10 years ago or never been tried in the real world. It's going to be the old stuff that always tried and has always worked.
So Nathan, why not have a CBDC backed by gold then? Why not have a digital currency that is backed by a hard commodity?
You could certainly do that, and they do exist already. They're already, there's a Tether Gold, and there's experiments like Gold Money from James Turk, which was doing the same thing, without crypto 20 years ago. So you could absolutely do that. You can do stuff. You can have gold-based things where you just kind of, touch things on your smartphone. Wisdom Tree is coming out with a new product along those lines. It doesn't mean you're going to buy groceries with Krugerrands, that's probably exactly what's not going to happen. So you can do all this. Of course, if you had a central bank monopoly digital currency supposedly based on gold, well, that might just be a promise that either is completely empty or, after 18 months, they make up some excuse to go off gold. And it was just a way of selling you on and their monetary monopoly system.
Okay. Perfect. So Nathan, thank you for your thoughts. Thank you for sharing your insights on inflation, and I look forward to speaking with you again soon.
Thank you. Been fun.
All right. And thank you for watching Kitco News. I'm David Lin. Stay tuned for more, and don't forget to subscribe to our YouTube channel.